U.S. fiscal deficit's been a problem since like the 80s, and nobody seems to care, right? It's not a today problem. Maybe in 5, 10, 20 years later problem. Or at some point, people start to say like, that's enough. So what's interesting to me coming into this year was if you look at US stocks, especially the tech side, whether you look at price to equity or price to book, it's historical all-time highs. Yet, obviously, US exceptionalism is clear.
Okay.
That's my highest conviction view, and I'm going to keep adding to mid-cap and value. Financials, industrials, and I do think contrarian high conviction view, China is getting delayed, but Z will come through and we will get a bigger and bigger fiscal, similar to 2015. Anybody who's willing to make a bet, I would keep my eye on Europe for a pop, but it won't be like strategic long-term rise, it'll be a pop.
Welcome to Global Money Talk. I'm your host, Dan Ha. U.S. equities proved to be, again in 2024, one of the strongest markets in the world. Will that continue this year? And where are the most attractive opportunities right now worldwide? Here to discuss the outlook of various markets and asset classes is Jae Yoon, Chief Investment Officer of New York Life Investment Management. Jay, welcome.
Yeah, thank you. Thanks for inviting me.
So before we jump into the outlook, could you please briefly explain for our viewers your investment process and sort of the key principles that make up that framework?
Sure. So I'm a macro asset allocator. So I actually do macro overlay and then allocate to underlying active managers to give me a bottom-up alpha. So there's two components to my product. There's a top-down macro overlay, and then there's the bottom-up active managers providing input. So in order for macro asset allocators to outperform, and we're benchmark-based products, so we actually have global equity fixed income portfolios of different risk postures, and we overlay a macro view, whether it's geography or large, mid, small, value growth, within the US, fixed income equity. So we can outperform by making a view and tilting to these various assets. And then high yield versus traditional fixed income, and then we give to the underlying manager. So we do look at various historical performance, relative valuation, and we are very valuation centric. So right now the market's all about momentum. It's all about retail going for large cap tech or large cap growth sector in the US. So we find that uncomfortable.
Okay, got it.
But that's what's been working for last, year plus.
Got it. Okay, so let's talk about outlook.
Yeah.
Starting with U.S. equities.
Yeah.
Where do you see U.S. equities headed for this year?
So what's interesting to me coming into this year was, if you look at last year, let's just look back at history. We came into last year with many equity strategies, fairly moderate. On average, they were calling for maybe 2 to 3% rally in equity market, yet equity markets clearly rallied way through. And most of those strategies were dragged to increase their targets. Coming into this year, where it got the flip situation, most strategies have a modest 5, 8 to 15% rally. No one's moderately bullish. They're pretty firmly bullish or quite heavily bullish. And I find it really interesting because if you look at US stocks, especially the tech side, whether you look at price to equity or price to book, it's historical all-time highs.
Right.
Yet, obviously, US exceptionalism is clear. If you look at the world geography, it's very clear that US economy is the only real resilient economy that might do well. You go to Europe, Germany, France, you go to Canada, Trudeau's about to resign, you go to China, you go to Asia, it's finding difficulty. Latin America, so clearly US economy is the only economy that has a clear advantage in GDP.
Right.
Now, valuation has already priced it in. So to me, this year, where will we end up? I think we're going to go sideways, maybe marginally improve. But the way I look at US equities, global retail investors, like we said, are going to focus on U.S. large cap growth for now. They're very fickle. Any headline risk, they'll be. So I think this year you got to expect some volatility, corrections along the way. But U.S. economy is solid, so I don't see it, going down a lot. And people might buy the dip and will go sideways.
Okay.
But I think sometime this year, as we progress through the year, view I would think is to figure out the timing to head for Europe. When the war for Ukraine's over, when European equities become just so cheap, people will move there. My only concern as an asset allocator is a much more strategic, 3-6 month to multiple year view. And Europe, to time that spring coil as it gets compressed, when is it time to jump in to take advantage? It's a tactical play.
Right.
Because strategically or longer term, Europe doesn't look very good.
Yeah.
So anybody who's willing to make a bet, I would keep my eye on Europe for a pop. But it won't be like strategic long-term rise. It'll be a pop. You go to Asia, China.
Yeah.
I actually like China. But we can talk about that because that's more of a contrarian play.
Sure.
U.S., I think I would tilt to value, mid-cap, and SMID-cap. I would stay with S&P 600 small cap, not Russell 2000.
Okay.
Quality small cap and mid cap. And then I would really, try to avoid taking a bigger bet on large tech.
Okay.
It's already quite expensive. I understand people have done great and retail investors aren't ready to give up, so it might keep going and any correction will be bought for a while until some headline will take it down for a correction.
Sure.
That's where we are.
Got it. What is the biggest sort of upside risk, though, to that view?
Yeah.
That U.S. equities, your view, likely to go sideways.
Yeah.
But under what circumstance, what would need to happen for U.S. equities to continue higher this year?
Yeah. So the good news about U.S. economy right now is GDP strong and consumers are amazingly strong, resilient. The wealthy in America keep spending. The lower income is having difficulty. Manufacturing has been in doldrum for the last 2 years. They're finally starting to show signs of life, restocking, etc. So industrial, again, value sector might do well this year. The thing that we're all watching is, the new administration, Mr. Trump, President Trump coming in. The tariff, is it a lot of rhetoric? Is he really going to impose a very severe global tariff? Or is it just a negotiation tool?
Right.
As we go into middle of the year, we're going to be keeping our eye on inflation. If inflation gets stronger again, it's coming down. But if it starts to find a floor and start to rise, and inflation happens very gradually, so you have to wait till middle of the year to end of the year. Now, if the tariff becomes severe, you don't have to wait. You know it's coming. But otherwise, if the tariff situation gets dragged through, negotiation process for next 6 months, and inflation is starting to get better, then upside. If inflation is getting higher, then I'd watch out. You can buy Trump negotiation threat, corrections, but I would not be buying inflation-driven corrections or declines.
I see.
Because inflation's sticky. Once it comes, you'll go. You'll go higher. Yeah.
Before we move on to ex-US, so you like S&P 600
and mid-cap,
and mid-cap. That implies that you believe that the rally will broaden out.
Has to broaden out.
Right. If that's the case, if that's the assumption, then why not Russell 2000? Because higher quality is better, but lower quality is probably more turbocharged.
Sure. No. So in an up day, Russell 2000 will absolutely outperform S&P 600. I think we're in an extended late cycle or mid to late cycle.
Okay.
This cycle keeps extending, because the government keeps spending money, etc., various reasons. In a late cycle, I don't want to be too cute. I don't see a big upside return. then you can go with big beta. We're in a cycle where there's be volatility. There might be even a fine, healthy correction coming eventually this year. So I keep my beta a little bit more tighter.
Got it. Makes sense. Makes sense. So ex-US, you did mention Europe, you did mention China. Tell us a bit more, please, about your views, ex-US, Europe, Asia, but also in terms of return potential with FX in mind for US denominated investors.
Yeah. Sure, no, absolutely. The dollar is going to be the most interesting driver, right? Because Trump exceptionalism is dollar positive. Dollar's actually at a historical highs. Not you have to go back to the 70s, 80s when US went through like a quite severe inflation. That period where the dollar was extremely strong. This is about like historical highs, except that period. So if we get reinflation, dollar will get strong because Feds are going to stop cutting and might hike. That drives dollar higher. A recession will drive dollar higher. But in a normal environment, this is about as high as it's going to get. So barring inflation, which may or may not come, barring recession, which is highly unlikely to come, the dollar will generally find itself peaking here.
Okay.
That's my basis.
Okay.
But again, things can be very, unusual this year. So in this world, I like China because China is clearly the written off contrarian view.
Sure.
Okay, and I think China can't get much lower. It's clearly getting lower even now. We're all waiting for Z to make his call, and he seems to be dragging his feet. I thought this is it, like September, but he's still dragging his feet. But he keeps talking about 5% GDP. So as long as the dollar is strong, I understand the U.S. investor want to stay in the U.S. But at some point, I think this year, on a base case, the dollar is going to peak and might start to head back down.
Okay.
In that case, you want to be overseas. I like Japan. Japan, I think BOJ is going to hike in maybe January, some delay to March maybe, but they're definitely on a hiking path. But the yen's so weak. So I think Japan's a structurally improving economy maybe next 2 to 3 years. It's got more juice or more positive equity performance left. Country like Korea, which is non-real from U.S. investors perhaps, I think it's gotten really cheap because geopolitical risk. Europe, like I said, spring coil, but it's kind of like you have to really be a good tactical trader to take advantage. Emerging market is the one that's really written off. And I think when the dollar starts to weaken, I would look at emerging market, but not until then.
Okay.
You have to have a bit of a view on the dollar before you go.
Got it.
Because we're not looking at recession, yet weakening dollar would be good for emerging.
Got it. So positive on ex-US, US dollar could potentially weaken from here. So that would be like, extra kicker to...
We have to watch that.
Yeah.
It's not clear on the timing. This year a lot will happen. The world money flow has come to the US for the last 3-6 months. That's probably going to have to find its way back out.
Got it. China. Do you see China getting better economically, or is your view that equities are just too low in China right now?
Right. So unlike Japan, where I have a structural positive view, China I do not.
Okay.
However, I think we have to go back to 2015. We had a similar situation where President Xi called for 150 billion fiscal. 2 years later, he spent 500 billion. So we're in that same situation. So you have to really look at history of China, Mao Zedong, Deng Xiaoping. If you look at history, China's found itself wanting to be a communist regime, and yet they are so dependent on capitalism to drive their GDP growth. And so Xi's making his pivot, and he's dragging his feet, or his administration, if you will, are purging and doing other things that's disruptive. But I really do think they're going to do more.
Got it.
It just seems to be taking longer. We've been waiting for 2 years, 2.5 years.
Right.
And I made this call last September.
Yeah.
So I was thinking 3 to 6 months, and now it's looking like 6 to 9 months, right?
Yeah.
The view.
Got it. And just briefly on Japan.
Yeah.
you're positive on the actual economy of Japan. Is willpower enough? The willingness to, or the willpower to, boost returns, and also to sort of stimulate the economy?
Yeah.
Because Japan's got a lot of structural headwinds still facing the economy. Demographics. Also.
Yes.
Yeah.
100% with you.
Yeah.
Long term, like very long term, the next like 10, 15, 20 years, demographic is clearly a problem for Japan. But next 2 to 3 years, there's corporate shareholder-friendly actions is one of the big catalysts. Japan's just cheap. And they've just got a lot of cash, like especially the finance sector. Japanese banks are coming to the U.S. To buy U.S. companies. They're going to grow.
Right.
So Japan is going to revive for the next 2 to 3 years. But to your point, as I look at next year or two, where's the yen headed? I think as BOJ hikes, yen's going to find itself heading towards like 145.
Okay.
But if you ask me in 10, 15 years, where is the yen dollar? I say 200. Got it. I'm talking 2-3 years structural.
Got it. Okay.
Enough for me to be bullish and invest and not think it's a tactical trade.
Sure. Got it. Coming back to, you did touch on inflation, but coming back to sort of rates, inflation, and commodities complex.
Yeah.
How do you see the relationship between those things kind of playing out between, pro-growth policies here in the U.S., tariffs, and therefore the impact on inflation, and therefore the impact on rates, and also commodities? Because obviously it's a multi-variable problem, right?
Well, if we get inflation back, it's pro commodities trade. Oil, I'm not so sure about because the supply glut and President Trump's push to increase capacity might keep the prices anchored. The natural gas is an interesting one. I'm actually long that. U.S. natural gas is pretty cheap, but Europe is very expensive, right? Because obviously there's a pipeline issue with Russia. But I think there's going to be an arbitrage. So I would buy U.S. LNG companies, not necessarily U.S. natural gas commodity. Because I think U.S. is going to be working on exporting to Europe and Asia to fill the gap that the Russia and Ukraine pipelines are going to cause issues with. And so I say that's positive structurally. I like metals, agriculture. Again, that will be a little bit linked to China finally spending money and creating consumer-driven growth and finally building back the property that a lot of people paid for and never accomplished building. So China play will also impact commodity. Inflation will impact commodity positive. So I like commodities. I like natural gas. I'm not sure about oil. U.S. interest rates, I think we're headed higher. You got the fiscal issue, etc. Now, a lot of, last couple of weeks, within a month, we have few institutional investors calling for 6% 10-year bond yield. And my view is, I think we might get there. In fact, I think we will get there in the next 2 to 3 years at some point because we have fiscal issues. But I always remind people, oil prices and interest rates don't go in a straight line. Because as they get too far too fast, economy takes a hit. And if we get to 4.5, we're heading towards 4.75, 10 years. If we get to 5 and we start teetering to break through 5, I think equity will have a bit of a correction. Yields will come back down. So it's directionally, I say 6% is absolutely possible on 10-year bonds. Not going to get there in a straight line.
Got it.
So I'm actually going to probably pick up some 10-year or long duration bonds, 475, 525. I got some limit orders there.
Okay. I heard you say on a different show, make America great again, but not if the rest of the world is all going down.
Right.
Which just shows you that it's a very delicate balance that needs to be achieved between pro-growth, pro-America, or America First policies, because everything is interrelated, right? If the rest of the world is going down, that has effect on commodity prices and therefore inflation, etc.
Yeah. So it's a circular logic. So U.S. is a consumer-driven market, and we import and we spend money.
Right.
So a lot of the export countries are dependent on exporting to the U.S. That's what President Trump's banking on in tariff and negotiating better deal for America, right? So that's all fair. In fact, Donald Trump for the last 40 years, since when he was younger, have talked about like the rest of the world's taking advantage of America. So he's clear on this one thing. Okay, and I think it's probably the right thing to do. Okay. Now, if you look at S&P 500 and U.S. companies, 60% of earnings come from overseas.
Right.
So if the rest of the world is in the brink of recession, some of the, Europe, etc., brink of recession, and if Trump wants to break it and create recession around the world, U.S. can't go along. That's my only point.
Right. No, and that kind of goes with, not many people think that the incoming administration's policies would actually be bad for the economy. Most people expect it to be pro-growth, good for the economy.
Absolutely.
But if the international relations, tariffs, if any of these things are sort of taken too far, it could actually cause the U.S. economy to tip into a recession.
And I'm banking on Mr. Trump, President Trump, understanding the art of negotiation. And again, this morning there was a news that, he's not going to impose a tariff. So he had to come out and say, yes, I'm going to. Because you can't negotiate if the other side doesn't believe that you're going to do it.
Right.
So he'll probably do it. And in fact, he'll probably do it in 3 places to prove to them, yes, I'm willing. But he's not going to do a universal, impose it on everyone.
Right.
He'll be selectively targeting enough for people to concede to him. If many concede to him and he feels the U.S. is getting a fair shake net, I think he will not push it to a brink of causing recession in pockets of the world that is not good for U.S. earnings.
Makes sense. That's a good point. A good point. So what is your highest conviction view right now? Out of all these that you described.
Well, I think in terms of broadening out, I believe, global retail investors are just clearly focused on, as we got into a bit of a correction going into December, only thing that rallied was big tech. And rest of my equal weighted view was doing great from summer to November end.
Right.
And then in 1 month of December, it lost a lot of money relative to tech because people bought the dip only in tech. That shows me it's global retail investors just buying the dip on tech only. I actually think if we're going to remain, and we are going to remain reasonably healthy in GDP and economy in the U.S. for foreseeable future, and hopefully most of 2025, then you do have to broaden out. That's my highest conviction view, and I'm going to keep adding to mid-cap and value, financials, industrials, and I do think contrarian high conviction view, China is getting delayed, but Z will come through and we will get a bigger and bigger fiscal, similar to 2015.
Got it. Do you see any excess of meaningful size building anywhere in the U.S. economy?
Excess. In what sense? Excess?
Excess that could, potentially lead to...
Oh, I see.
Yeah,
like a bubble.
Yeah. I don't want to use bubble too lightly.
Right. Something that could pop.
Right, something that could potentially build into that.
Yeah. I don't see... Well, the fiscal deficit's a bubble.
Okay.
So what's going to be interesting is Bassett. How is he going to handle the fact that prior Treasury, won't mention her name, has left him with a big problem to solve. And in order for President Trump to continue on with his pro-growth, tax cut, maybe even spending policy, Bassett needs to solve how to issue more Treasuries. And his goal of 3% deficit how do we get there? So to me, he's very capable. A lot of Wall Street is very respectful of him. But the problem itself is also pretty difficult. So that could be one thing that could cause turmoil.
A lot of people...
And by the way, retail investors buying U.S. tech is already a bubble, right? Price to book, price to earnings is pretty high.
Yeah, got it. I mean, the government deficit situation, I know a lot of people know it, but I think most people kind of feel like, well, it's not really a problem.
Yeah.
It's not really an actionable problem.
Sure.
In your experience, you know, you've been doing this a long time.
Yeah.
How does one deal with this?
No, so that's right. Stock markets like to look forward 3, 6, 1 year. They're not going to look at a problem that's like far out, right? So U.S. fiscal deficit's been a problem since like the 80s. You know, we had that ticking clock.
Sure. And
nobody seems to care, right? And that's probably right. It's not a today problem or a 2025 problem. Maybe in 5, 10, 20 years later problem. Or at some point, people start to say, like, that's enough. But I think the fact that, you know, going back to the 80s, the rest of the world will demand, or U.S. investors included, will demand a higher real yield. It's happened in the 80s, right? When we had a big deficit issue building. So that demanding higher real yield is maybe a tipping point this year. That's where some of the investors are calling for 6% 10-year bond yield is two factors. Inflation might reaccelerate, you know, and Fed might have to stop cutting. The more Fed cuts, the steeper the yield curve is going to be this year. Until a point, inflation might reaccelerate, and then you have to watch President Trump's actions. And then, you know, we're going to worry about the fiscal deficit then.
Got it.
So it's a longer term issue, but you might see a higher volatility in equities because of valuation issue, higher volatilities in long dated bonds because of inflation. Again, middle of the year to end of the year, you have to watch that.
Got it. Got it. Institutional adoption of Bitcoin.
Yeah.
That's a widely held expectation.
Yeah.
You are an institutional investor.
Yeah.
How close is that expectation to reality in your experience?
Yeah, well, it's not clear, right? So, you know, a few of the insurance companies have bought a little bit of Bitcoin, not because they believe in Bitcoin. I think some of us have a venture investing, you know, disruptive technology. So as part of that, we do invest in disruptive technology companies, you know, in venture space to keep up with disruption. By investing in it, you get a piece of the investment process, but you're really watching and participating, right?
Right.
However, it's not a view that Bitcoin necessarily is going to be a big run-up asset. I think BlackRock institutionalized acceptance of Bitcoin or crypto. So now there's more cryptos being created, et cetera, et cetera. I think it's a longer term process. In order for me to treat Bitcoin as another so-called asset class like commodity is already volatile, okay, despite its established asset.
Yeah.
Bitcoin is massively volatile. In order for people to treat something as an asset class and want to invest in it, the volatility does have to come down. It's not, otherwise it's just too much volatility to be something that people are going to invest much more strategically.
Got it.
But it's heading in that direction. I just don't know when.
Got it. So it's not an operational or administrative sort of hurdle.
Yeah.
It's really the volatility of the asset class.
It's got to come down. It's got to settle. And second, as I talk to some of the strategists on Wall Street, and I asked them, when will you plan to include crypto or Bitcoin in your forecast as they make their estimates or forecast of various asset classes, and they don't have plans? How about like they start following it and start giving us like price targets? Then it might be considered an investable asset.
Got it. Got it. Well, that's all the time we have for today.
Sure.
Thank you so much. It's been a pleasure.
Thank you. Thank you very much.
And to our viewers, thank you for watching. We'll see you next time.